In this video, we're going to go over candlestick patterns. So a quick overview. We're going to look at how to read candlesticks, combining different candlesticks together, uh, the different type of candlestick patterns there are, reading charts through candlesticks, and eventually how to not trade candlestick patterns. So getting straight into it, how to read candlesticks. So the very basic way to read a candlestick is that when we see a candlestick like this, it represents kind of like a story. So when it's a green candlestick like this, it means that the price opened at the bottom of the range of the candle here. So let's say at that price it was €5. Price then made a high of this point here, the highest point on the candle, and let's say that was €12. Price then came down, made a low of about this point here, which we can say is €4, and then eventually closed at this price here at, let's say, 10. So because price closed above the opening price, the candlestick is therefore green, showing it's a bullish candle. Now, the same thing applies to the bearish or the red candle, just the opposite way. So when the candle is red, it means that the price opened at the top of the range here, let's say 10, made a high of around this point here at, let's say, 11, made a low of this point here at, let's say, 6, and eventually closed at this point right here at about 7. So since it closed at a price below the opening price, the candle is therefore then red. So a few terms like these lines here are either called shadows or wicks. And this kind of the red part of the candle here is known as the body or the range of the candle. Or some people call this the range including the wicks. Some people call range just the body. It just depends. So the different types of candlesticks. So here we're going to look at the bullish candlestick patterns, and here are the bearish ones. So if we look at the first candle here, this is the most bullish candle you can get because we can see that there is no selling pressure, there is no wicks present. Price opened here, shot up and closed at here, showing strong bullish momentum. This candlestick right here is a very popular one. It's called the hammer or the pin bar. So what this represents is price open at this point here. Sellers then tried pushing the price all the way down here. But the buyers then pushed price all the way back up to eventually close above the opening price. This shows that there was a lot of bullish pressure, a lot of bullish momentum coming into play. So yeah, if we then look at this is just a normal bullish candle. It's very common. It's kind of like similar to the one we seen here. Uh, Two wicks, yeah, relatively large body of the candle. Not much that one. Uh, this one here, this one is either called not necessarily a doji. A doji is more just literally know the same opening and close, but this is like an indecision candle. We don't really know what the market really wants. Even though the candle is green here, it still represents indecision in the market. We don't know whether buyers are in control or sellers. So this candle right here is the least bullish. This in fact represents, even though it is green, it represents selling pressure in the market. This is the opposite of the hammer. So in this, we can see that the price opened here and buyers pushed the price all the way up here. But then sellers came in and pushed price all the way back down to eventually close here. And even though it did close above the opening price, it still shows that there's a lot of bearish momentum. So if we look at these candles right here, they're more or less the same as here, just inverse obviously, because these are bearish candles. So this is the most bearish. I'll go over them quickly. Price opened here and closed here. This shows strong bearish momentum. Here, this is the inverse of the hammer. So we can see that price opened here. Buyers tried pushing the market up, but then sellers came in, pushed the price down, and eventually closed lower. This shows very strong bearish momentum. This candle right here is just your basic bearish candle, 2 wicks at the top, large body. Here we're back to the indecision. It's pretty much the same as this one right here. It shows indecision in the market. We don't really know whether buyers or sellers are really in control. And this one is the least bearish. This candlestick right here and this candlestick right here, they're pretty much exactly the same. They tell the same story. Even though one is green and one is red, they're both buying pressure. And I'll use a different pen. These two candlesticks here are the same as well. Even though one's green, one's red, they both represent selling pressure. So combining candlesticks, you don't necessarily really need to know this, but it is just, I think, interesting to know how candlesticks work. So you're actually able to combine candlesticks. So let's say you're looking at an 8-hour chart. So on the 8-hour chart, this is what you see. You see this inverse of a hammer. And if you go down to the 4-hour chart, it would represent these two candles. So that on the 8-hour would equal to these two candles on the 4-hour. So how does it work? So if we go to the 4-hour chart and we see these two candlesticks right here, and let's say we want to know what it would look like on the 8-hour chart without really going to the 8-hour chart. It's kind of pointless, but I think it is interesting still. So how this works is you take the open of the first candle, which is this green one here. So we know that price opened here. So we bring the line across like this. So that's where this new candle will open. We do the close of the second candle. So price opened here, closed here. So we drag this point across. So we have the open here, we have the close here. So then we find the highest point on either candle, which is they're pretty much the same here. So just bring this point across and you bring the low of the lowest point on either candle as well, which is this point here. So you bring that across. And that's basically how you combine candlesticks. So this methodology applies for pretty much all charts. So, oh, this applies to pretty much everything. So use the open of the first candle, close of the second candle, and then the highest point on either candle and the lowest point on either candle. Candlestick patterns. Now, there's tons of candlestick patterns, and these are just some of the ones I personally use myself and that I like the best. So we'll go into engulfing patterns. Now, engulfing patterns, I think, are probably one of the strongest patterns. So basically, what it is some people have different rules when it comes to engulfing patterns and for all these other patterns as well. So for this one, this is a bullish engulfing. This is when if you have a bearish candle here, right? And the next candle is a bullish candle. And the entire kind of range of the candle is engulfed within this new bullish candle. It shows signs of great bullish momentum and strength, and that buyers are in control. And the same goes for then the bearish engulfing. We can see that bullish candle formed, and straight after we see a huge bearish candle form, which basically engulfs the range of the entire uh, green candle. Now, some people would say that the rule for engulfing pattern is that we want to see. So let me give an example. What some people would say is for it to count as an engulfing pattern, we have a candle right here, right? And we have then a green candle like this. Now, some people would only count this as as a bullish engulfing. Now, what's the difference between this one and this one? Basically, what some people would say is they want to see that the entire range of this candle should be within the body of the next candle. So in this one, we can see that the kind of the wicks are being engulfed in like these wicks. They're not entirely within this kind of like body right here. So some people won't count it. Some people have rules that they want the entire candle within the body of the next candle. So people have different rules, but it's whatever you feel works best. So the hammer candle, that's what we went over previously. It's probably the most famous, well-known type of candlestick pattern. It just shows signs of strength. We can see that, as I mentioned before, sellers brought the price all the way down here until buyers push price all the way back up. And then I'm not going to go over too much. And the same for inverse is just the same. Buyers brought it up, sellers brought it down. So on to the next one, morning star and evening star. This is where we can see where we looked at the indecision candle before. We don't really know what the market is doing, but if you trade it using other candlesticks with it, it can really help. So a morning star and an evening star. So basically what it is let's say price is approaching a key support level right here at this area right here. You wouldn't want to trade this just by itself, and this applies to all the patterns. You want to make sure that you're using market structure, key support and resistance, like areas of values, and not just trading candlesticks on their own. But yeah, so price is approaching a key support level, and we can see at this point right here, it makes this kind of indecision candle. Even though it is green, I would consider it an indecision candle. And at this point, you don't want to do anything because you don't really know whether price is gonna bounce up or go down from there. So then we can see that straight afterwards, we can see the strong bullish candle form, which then signifies that okay, it's likely that price is now going to head higher. So then you could maybe put an entry there, a stop loss there, and then right. And then the same thing here. just the inverse. Price is approaching resistance. We see a indecision followed by a strong bearish candle. There's a probability that the price will head down lower. So now take a look at tweezer bottoms and tweezer tops. These I think are really effective. I don't know why, but I think they have a really high probability of working. So basically what it is same thing, price is kind of approaching key support level. We see that price makes the same lower low, the exact same. And there's a high probability that then price is going to go up because it shows that sellers are failing to push price down. And then same thing for up here. Obviously, sometimes it doesn't have to be exact. The closing and like the top point and the bottom point don't have to be hang on perfect, but when they're like close to being equal, I think it still counts. So same thing here, price is approaching a key level of resistance. Price makes the same low, same high, eventually then and falling down lower. So this, I think, this next pattern here is not really a pattern in itself. It's kind of looking at a group of candlesticks. So when we see that there is a clear key level of resistance or support, which let's just say here, we can see that this level caused a significant move down. So we can see that this is a very key area, and it's likely that when price reaches this area again, that it is going to cause a sort of like effect on the price. So we can see as price approach this level here again, we can see that there's multiple long wicks showing that there's significant level of selling pressure occurring at this point right here. We can see each time buyers push the price up, sellers continuously just bring the price down. Eventually, then we can see that the price did head down lower. And I think this is really effective. If you use this at a key higher time frame, support resistance, um, at a trend line here and do a break of trend line on a lower time frame and then trade that lower, I think it's a very profitable strategy. So here we have I couldn't get a prime example, but basically what this is meant to showcase is what I like to call shrinking candles. So if price is approaching a key resistance, and also same thing if this is bullish, just the inverse, you just want multiple candlesticks on a key support level, obviously. Anyway, in this case, this is shrinking candles. So when price is approaching a key level of support resistance, we don't want to see large bullish, or in this case, yeah, sorry, large bullish candles kind of heading in that direction towards that resistance level. We want to see that momentum is slowly losing. So we can see that we had a bullish candle here, a slightly smaller bullish candle here, followed by kind of like an inverse hammer, bearish candle, and then finally a huge bearish candle showing momentum. So what I'm trying to say is that when price is approaching a key resistance or support, we want to see that the candles that are heading in that direction start to grow smaller and smaller. And when price reaches this area, we want to see wicks forming to show that there is selling pressure and that price is failing to break above that level. And then eventually, when we see momentum change and shift kind of towards the opposite direction, that's when we want to get into the trade. So finally, we have one white soldier and one black crow. So one white soldier and one black crow is when the it opens above the previous day's close and then closes above previous day's open. So we can see in this candle the price closed, sorry, the price closed here, but actually opened up here, and price opened here and closed here. So it's basically just the candle kind of going in like a diagonal kind of way, and then same with one black crow, it just kind of going in this like diagonal way. It shows that there's strong bullish momentum or bearish momentum, obviously, just depending on which one you use. So that's it for candlestick patterns. There are so many different types of candlestick patterns, but you just need, I think, like a handful that you know how to trade. I wouldn't say memorize candlestick patterns, but don't overwhelm yourself with like learning a whole bunch. But anyways, reading charts through candlesticks. So when you look at a chart, when we're looking at a trending move, we want to look at large range candles moving in the direction of the trend. So in this case, we can see that here we can see large kind of bullish candles right here. These are like the trending moves heading towards in that direction. And we can see that before price is coming down, we can see kind of like a shift as price loses momentum, and we'll get into it. So then retracement move, small range candles uh against the direction of the trend. So that would be like kind of like these moves here would be a lot kind of shallower and like smaller candles. Whereas I think honestly this side is a better example, to be honest. So if you're looking at large candles moving in the direction, these moves, and then small range candles against the direction of the trend, these moves. See, the only reason this example kind of here isn't great is because we're this is the part of the chart where we can see momentum slowly losing. We can see that the range of the green candles is slowly getting smaller, and then the red candles are slowly getting larger and larger, and it's kind of going in. See the difference in the highs. Look, it made a high here, and then it's kind of like slowing down. It's failing to really push that price up. And that's a very strong indication right here that price is eventually going to break out. It's kind of making this wedge pattern. And eventually this break of this trend line then triggered this huge bearish downturn right here. That's another strategy, but yeah. So current market structure is likely to change if there is a large retracement move, i.e. reversal happens if trending moves get smaller and retracement moves get larger. And that's basically what we just talked about here, as the bearish candles slowly gained more momentum as the bullish candles then eventually lost their strength, and this market then reversed down. So finally, how to not trade candlesticks. So don't memorize candlestick patterns, and don't trade candlesticks by their own. So you don't need to memorize, as I said, a bunch of candlesticks and then just look at charts, and then any chart or like pattern you see, you just want to trade it. It's not going to work over a long run, and you don't want to trade them by their own. Candlesticks are something you want to use with kind of like other variables, other factors, support resistance, market structure, maybe another indicator, Fibonacci. There's a lot of things that come into play. You're looking at the trend, you know, so you don't want to just see like, for example, a lot of people what they would do is they see a hammer in the chart and then they just buy, assuming that it's going to go up without any other really context within the trend. It's really important that when you're trading, you want to trade with confluence. And confluence trading is where you're using kind of loads of different factors and variables to come into play and to take high quality, high probability trade. You don't need to trade every pattern or like everything you see. You want to take good trades that, follow your strategy. So then what should you do? Ask instead, where did price close relative to the candle range? So what that means is, let's say you have a candle like this. Well, we can see that price opened here and closed here. So we can see that it's a bullish candle and it's a very strong bullish candle as well. We can see that the body is very large and the range of it, like the wick it's negligible. Whereas if we're looking at this, even though it is a bullish candle, we see that price opened here and closed here. And relative to the range, we can see that there is a large selling pressure. So even though this is a bullish candle, as I mentioned before, it still shows signs of bearish strength. So what's the size of the candle relative to the earlier ones? So if you just have kind of like a group of candles in a given direction, and then eventually you start seeing huge candles, it shows that, okay, strength, the momentum is slowly picking up, and relative to the old ones, we can see that now price is, heading either up or down. And then eventually, sometimes focus on a group of candlesticks rather than just one individual. And I think that is so important. Like looking back at this here, I think this pattern here is probably one of my more favorite ones when we're looking at a group of candles. Like if you look at within itself, this is, an inverse of a hammer, but like here we have indecision and like, but looking at the entire group, looking at the market structure, I think it just adds so much more than just simply looking for like one white soldier or like one engulfing pattern. I think it just works so much better. So that's it really, yeah. I hope you got something out of that. So yeah.